The question I was asked most frequently during the past summer, where volatility in the markets reigned supreme, was what should an individual do with their portfolio during times like that? And my answer invariably was it depends a little bit on whether you're trading the market or investing. Trading isn't about being right all the time. Professional traders are typically only right 55 to 60% of the time, but what makes them successful is that they limit their losses and allow their winners to run and maximize their gains as a result. Risk management and discipline becomes paramount, or is paramount at any time really for a trader, but during times of volatility it's that much more significant. So if you were to ask me what a trader should do during periods of volatility, the first thing and the biggest thing that they have to do is to cut down the size of their positions so that they're less likely to get stopped out of those positions on an adverse price movement. For investors, volatility in the market creates an opportunity that if the portfolio is properly structured, they should be able to take advantage of for the long-term gain. Investors typically have a longer time horizon than does a trader. And whereas a trader is concerned with stopping out of positions based on adverse price movements, if a portfolio is properly structured with proper asset allocation, investors will be able to ride out downturns in the market that result simply from market activity. Where investors need to be vigilant during market downturns is that the companies that they own are unaffected or minimally affected by the economic ramifications of that downturn. In other words, that the companies are still able to execute their business plans over the long period of time and thus generate the free cash flow that the investor assumed when they purchased that company in the first place. If your portfolio is properly structured and you know what you want to buy, it makes it very easy during a market downturn to essentially cherry pick and to add companies that represent significant value. Toron was able to do that during the month of August when we purchased a Japanese chemical company that we'd watched for a number of years. We liked the management, we liked the company's ability to execute their business plan, but up until August of 2007, we felt that the stock was richly valued. Overall, the correction in the market that ensued in August brought that stock back into a realm where we were willing to purchase it. And as such, I think client portfolios will benefit in the long term from being able to add that stock at an opportune time. The other opportunity that volatility creates is the opportunity to rebalance portfolios, and that's particularly evident if we look at the Canadian dollar and the movements that we've had vis-a-vis all major world currencies in the last 4 or 5 months. The strength in the Canadian dollar has essentially made the Canadian dollar holdings in a global portfolio more valuable relative to their foreign counterparts. And as such, during periods of time like this, it's an opportune time to sell parts of those Canadian dollar holdings and allocate them to some of the global equities that haven't been performing quite as well. When the Canadian dollar reverses its course, the foreign portfolio, the foreign components of the portfolio will inevitably benefit from having a higher weight in the portfolio. Neither trading or investing is easy, and both have different ramifications when it comes to volatile periods of time. For traders, I think they need to be wary of volatility and need to govern their actions accordingly within the market. For investors, if they've properly structured their portfolio and they've done their homework, volatility should create an opportunity to enhance the long-term yield of their portfolio.